Welcome back. Well, let's get a little macro now. We have Siddhartha, Sanyal, Chief India Economist at Barclays, joining in for a quick chat about the RBI policy as well as his take on what growth is looking like at this point in time. Siddharth, hi, good to see you in today. First, wanted to start by asking you about growth. We have Q2 GDP, which came in largely in line but better than the previous quarter at 7.4%. But right after that, we had the auto sales, which were completely disappointing this time round for the month of November. We had the manufacturing PMI, which came in at a 25-month low. And this morning, we had the services PMI, which came in at a 5-month low for the month of November. What is high-frequency data indicating to you in terms of growth right now?
Yeah, that's a very interesting question, Ekta. Basically, what's happening here is we think there is a broadly growth recovery stays on track, but we need to be careful about two factors. It's not going to be any big spike up anytime soon. It's possibly going to be a very gradual process, number one. And we have to live with a bit of uneven upticks. It might be from quarter to quarter uneven upticks, from sector to sector occasionally. For example, at the moment we are seeing urban growth is doing relatively better, but we are not at the moment that confident, or we are not seeing that kind of an uptick in case of rural growth. On the other hand, we are seeing, if we look at the capex cycle, the government spending, again, which also had been somewhat volatile over the course of the last few months, but by and large, they tried to support the capex part and spent a bit of money on certain projects, roads, highways, etc., being on the forefront. But at the same time, private capex still remains pretty weak and might actually stay weak for a while. So as a whole, it's a bit of an uneven uptick, and it has to be a gradual uptick. We see growth moving from 7.3% in the previous financial year, going to around 7.5% in this financial year, but eventually towards 8% in FY17.
Siddhartha, hi, good morning. The other talking point, of course, was the RBI monetary policy and the statements from the governor. What did you make of that, and what's your call now in terms of any more incremental rate cuts which are still left in the system?
I think the statement this time was a very balanced one. There was no rate action as expected, and we were expecting a balanced statement, so it went perfectly in line with that expectation. If at all, I would say the statement this time was slightly more softer than what we had expected. So basically what's happening here is RBI policy, as the governor reiterated in the statement as well as in subsequent interactions, that they want to stay data dependent, and as numbers pan out, if they are favorable, they are not averse to the idea of offering more easing. So it's some kind of an accommodative stance with a strong vigil on the inflation scenario. Our sense is that inflation will not really trouble us much in the near future. We see numbers, which is the CPI print, which is today at around 5%, going to about 5.5% by the end of the financial year, and broadly hovering in the 5 to 5.5% range in the near future. So if I see that kind of a scenario, and as we discussed earlier, that growth uptick still remains uneven and at a very gradual pace, I think there is still room for a little more easing on the part of RBI. We factor in about 50 basis point, that is 225 basis point rate cuts in the first half of calendar year 2016.
So would one of them be pre or post budget?
Well, our baseline scenario as of now, post budget, both of them. So we are expecting one in early April to start with, but everything remains as the RBI has also reiterated. Their stance remains very, very data dependent. If our incremental data points suggest there is more easing on inflationary pressures. And I'm not necessarily talking about the backward-looking prints, but generally the touch and feel of the economy, that whether incrementally going ahead, forward-looking inflationary pressures are relatively less, that might open up space for RBI somewhat earlier. But as of now, our baseline scenario is to expect the first cut in early April.
And what's the risk to your call, Siddharth? Because we had one economist saying that there's going to be no rate cut at all now. Since you're expecting 50 basis point rate cut in the first half itself, what would be the key risk to your call?
Right. Well, I think there are two risks at least which are worth watching. First of all, the global financial markets and global economy remain somewhat volatile, and there is a lot of uncertainty around that. So our baseline scenario is that because of that, commodity prices still remain relatively well anchored. If there is a change in that, or if there is for central bank actions or some other policy actions elsewhere, there is a big spike in uncertainty and volatility in the financial market that can create some kind of uncertainty. The other risk, which is also very, very powerful, and we still know very little about it, is weather-related aberrations. There is still there again talks about some kind of an El Nino, a big El Nino in 2016. So if that really turns out to be possibly worse than what we are factoring in now, that might be another big risk. As of now, what we are seeing that, yes, the El Nino risk is there. We recognize that. We think there can be pressure on food prices going ahead in mid-2016.
Sure.
But what is giving us comfort at the moment is other inflationary parameters or other factors are reasonably benign. So we do not really expect the average inflation is, for us, FY17 average inflation is around 5.3. If there is a big change because for the El Nino factor to that particular projection, the RBI forecast would have to be reviewed.
Okay, just a quick question and last one from my side, Siddharth, is about the open market operation which was announced by the RBI worth around 10,000 crores, which is going to take place in terms of a buyback on the 7th of December. Your take on that and how it might impact the yields?
Well, there had been quite a bit of easing in on a lot of macroeconomic parameters in terms of, like inflation pressures or rate easing, but we hadn't really seen that getting translated into some of the market-driven rates. For example, yields had been pretty high for a while. Now, given that RBI is supporting on the demand-supply mismatches, which we are seeing now, RBI is supporting liquidity. I think RBI is supporting liquidity, but as a byproduct of that, the demand-supply mismatch, which is impacting the government securities market at the moment, is also getting benefited. So that should help the yields, and once yields starts easing a little more, that possibly helps the overall agenda of better monetary transmission in the system, as and when we see yields softening in a more sustainable way. So that's possibly a welcome change on this, or welcome development, I would say, on the part of financial markets, government securities market in particular.
All right, Siddharth, we're going to leave it on that note and wish you a good and successful conference as well. Thanks very much for joining in and chatting with us this afternoon.